You have invested in a startup company, you have been with it on a journey. It's probably been a bit like that, but you are getting to a point where either the company should make a general exit in some form, or you want to make an exit from the company. So this is called a liquidity event in any case. Funny expression, but I don't know who came up with that, but it's a liquidity event that raises some money for somebody, either the company or you as an investor directly. How can you do that? In principle, there are 4 different ways. The first is that the company sells some assets, and that gives the company liquidity, which can then be shared among the shareholders. The second one is that the company, nothing is changed for the company, but you have shares in a company, you sell your shares, and everything else goes on as normal. The third one is that the company in some way gets sold to a strategic buyer who really likes the whole franchise, who likes the business. And the last one is that shares get listed or available for the public, and then any shareholder can choose when or if to sell their own shares. So 4 different ways. So let's go through them. And we start with the selling of assets. What can you sell? I mean, one simple thing, it's most common with mature companies and also in companies in industry, but it is that they own a building. So they own a building for instance, an office building or a factory building, and they're working from there. But instead of owning it, they sell that building and then they lease it. So they make a sales and lease back arrangement. So they stay and everything continues as before, but maybe now it's a pension fund that owns this hard asset. You can also sell other assets in that way. But there's also the possibility of selling intellectual property rights or some other rights. This can be in the form of, for instance, a patent that is not so valuable for you, but it might be for somebody else. You can sell commercial rights, like you sell the exclusive distribution rights for an area you're not in yet. So you get some money in that way. On the other hand, of course, you wave goodbye to some upside in the future, but that might be a good decision. Then there are some companies that have a lot of activities. So we start this, we start that, and so on. So then you start selling this as spin-offs. So you can even be mushrooming this all the time, so you keep making small spin-offs that you sell off. I know a couple of companies that do that a lot. In any case, it raises some money for the company, and then the company can distribute, if it wants to, that money to the investors. The second one I want to address is the secondary sales of assets. So this is where the company continues unchanged, but you as a shareholder want to sell. So you either offer to the company that they can buy back your shares. Sometimes, if not often, you have a shareholders agreement that have some rules for that. Maybe there are some standard metrics, maybe there's another way of doing it. The alternative is that you, perhaps through a middleman or your personal network, you try to find somebody who wants to buy your secondary shares. So this is a way for one shareholder to get out when the other ones want to keep it as it is. Now let's move on to the third main category, which is to sell to strategic players. One is what is called a corporate earnout. So you sell the company. Let's say you have developed a new pharmaceutical technology. It's still a little bit dicey there. It's not entirely approved and so on. But you sell it to a very big pharmaceutical company. And everybody keeps working in the company, but the shareholders, they get paid a little bit when the transaction happens. And the rest, they get paid over time as the company meets its milestones. And this is called a corporate earnout. And if you leave the company, or if it doesn't deliver, then we reduce that amount or we stop. This is quite common because it's more flexible. There are similar situations where you as a person keep working for a company after it's sold, and you get paid something at the sale, but you also have personal earnout. So as you deliver on your personal milestones, and also as you just simply show up for work every day, you manage to get more and more paid out. Sometimes the total amount you can get in principle is higher in this way, but in some cases also there will be some discussion and conflict, because maybe the milestones that were defined get kind of irrelevant, because your milestone is to sell so or so much of this product, but the big company that bought it stops supporting the product you are supposed to sell or whatever. So it's not without its complications, and I've seen quite a few lawsuits in different companies relating to that. Then you have the possibility of making a joint venture with somebody else, but where you have an option to divest. So basically, you form a new company with another company, you build that company up, and then when it reaches certain metrics, for instance, or in any other way, you have an option in the future to sell your part to the other investor. So in that way, you get an exit route. It's not instant, but it might be very good because you get added value by working together. It's a good model for both parties because it's flexible, but it can reward you very well if you deliver, but not so much if you don't deliver. There's a possibility of taking in partners. This is something you see very often in law firms, for instance, that you have a number of partners in a law firm or management consulting firm, and one partner wants to get out, but then another partner gets in, borrow money, and buy your stake. But there's a much bigger variation on this, which is called the management buyout. So there's an active management in the company. They own a small part of it, perhaps. And they're very good at what they do. And the company depends on them. So you don't want to sell the company. You don't want to IPO. You simply want them to buy you out. Problem is they don't have the money for that. Very often, though, they can find the money for that. So you help them finding money from a bank, for instance, or some other funding company, so that they end up getting control of the company, or they end up owning all the shares in the company but having a debt. And that debt has been assumed in order to pay you out. So that can be a very, very good route for everybody. Of course, it depends on their ability to find somebody who will lend them the money, but in many cases they can. If it's a mature company with a predictable future, in many cases they can. Then there's, of course, the strategic sales to a big company. This is very common. For instance, it's like 10 times as common as initial public offering. So they trade 10 times as many sales to other companies as their public listings. So the valuations in those cases can be very, very different depending on the specifics. So the best situation is that you have this big market, you have big players, they have lots of money, they have big sales forces, but they don't have the technology you have. You have this unique new product. So you hire an investment bank, they might charge, say, 3% or even more of the transaction, but they go out and approach all these big companies and say, this company is now going to be sold. Do you want to be the one who buys it, or do you want to be the one who sees your competitor buy it, and then your competitor being able to offer this product that you cannot offer? In these situations, sometimes you get very, very high valuations because you are not only paid for the immediate value of your forecasted revenues and profits. No, you're paid for the much bigger profits that a more powerful company can get out of your technology. Plus, you're paid by the fact that they're willing to pay a premium for avoiding that their competitors have this, because they think, it's a very valuable part of their product lineup. And these are the situations where you can get really nice valuations. So this can be a very, very nice way to make an exit. And also it's clean. It's a complete takeover. In some cases, by the way, in the way that they buy all your assets and close down the company just to make sure that there are no hidden problems with contracts or whatever. But it's a clean and simple way to do it. And the last one I want to mention is one that people very often forget, but it is selling the company to a private equity fund. You sell the company to a private equity fund because the private equity fund has an ambition involving your company that you might not have. You might think of the company as, this is my company, this is my market. They might have a much bigger plan of doing a consolidation play of all the players in an industry, or putting what you have together with something else that they are in the process of buying, and by combining it, creating something fantastic. But they buy out everybody, and at one point own the entire company, but then immediately issue stock options to key management that they want to keep. So that can be quite interesting, and it's a route that many people ignore, they don't think about, but it can be very, very useful for everybody. So this was number 3, this was selling assets or selling the company to strategic buyers. The last one is to create this public market for the shares, and that is an IPO, so initial public offering. But it also has its downsides because it's quite expensive to be listed publicly, because you have so many information requirements. And a variation of that is the ICO, so initial coin offering, which I think is more for the smaller companies, but that is where you simply create a public market for your equities, and then any of the shareholders can choose when to sell. So if I should summarize all of this, the important point is to think that if the company wants to make an exit, or if you as a single investor in the company wants to make an exit, consider there are a lot of different ways to do it. And what I've just said, what was listed here, was 15 different ways to make exits. So please think about all of them. Be a bit creative before choosing what to do.
Do you speak future?